fact is, who is driving credit growth in the US economy? Is it the private sector? No, it is the public sector. And effectively, it's the state that is back in control. The reality is that we know it always ends badly. It ends in inflation. And what you've got to do is to get monetary inflation hedges into your portfolios. The yield curve is telling you that. The performance of sectors are telling you that. The weakness of the dollar is telling you that. The outperformance of international markets is telling you that. And therefore, it's not surprising that the other shoe to fall is poor quality names performing.
And what do you think could end this in 2026?
Oh, I think undoubtedly it's basically a disturbance in the funding mechanism.
Today's episode of Monetary Matters is brought to you by VanEck semiconductor ETFs. Later on, you'll hear more about the VanEck semiconductor ETF, ticker SMH, the largest semiconductor ETF, and their newer VanEck fabless semiconductor ETF, ticker SMHX. Let's get into it. Very pleased to be joined once again by Michael Howell of Crossborder Capital. Michael, welcome back to Monetary Matters.
Great to be here, Jack. Looking forward to it.
Michael, we're going to be talking about all things liquidity. You've been called the Godfather of liquidity. Before we talk about your views on liquidity and what they mean for asset markets, just give us a rough sense. How are you assessing the current state of liquidity in markets across the world? What are you saying?
Well, I mean, right now it looks pretty good. There's been a lot of liquidity coming into the US markets, really courtesy of the debt ceiling over the last 6 months. I know there are a lot of fears over the next 6 months about whether that money is going to be taken out again. I'm not so sure it will be. So I think liquidity in the US still looks pretty good. And then you've got on top of that, what's happening in the rest of the world. And the fact is the weakening dollar has encouraged a lot of central banks around the world to ease. What we know is that of all the central banks we monitor, and we monitor close to 100, about 80% now are actually in easing mode. So that's a high number for sure. And in particular, if you look at what China's doing, China is injecting a lot of liquidity into its money markets in serious size for the first time in some years. So China in the last 6 months has added, something like 10 trillion yuan, which is close to $1.5 trillion. They're probably going to do the same again, but this is a great start.
And Michael, just how closely do you connect that easing in global liquidity conditions to the very easy financial conditions across the world? For example, the high yield bond market credit spreads are near record lows. The stock market, as we record, is at an all-time high. Bitcoin is at an all-time high. Gold is near an all-time high. Just how closely are these things connected, and do you expect it to continue?
They're connected 100%. There's no question about that. And I expect it's going to continue for a few months yet. I think the thing we've got to remember here is that this cycle is getting old. It's 34, 35 months old. So it is mature, and we've got to be cognizant or aware that the risks are that it could suddenly end. I think that's a few months away yet. I think we're not talking about 2025. We're talking about 2026 for an ending. I think that end date has been pushed out really by the latest bout of easing, which has come on the back largely of a weaker dollar. But I think that we're getting close, but we're not there yet.
And what are the most salient issues for global liquidity right now?
Well, I think the most important factor by far is really the integrity of the collateral markets, in other words, the integrity of the bond markets. I think this picture that we're in, or the situation we're in, reminds me a lot of what happened in the late 1980s when we had a similar dollar weakness. That came in the wake of what was then the Plaza Accord in 1985. That period of dollar weakness encouraged a lot of central banks around the world to ease liquidity conditions. We got strong markets up until the time when markets crashed in 87. But the trigger for the crash then was really a dollar that was weakening and inflation that was picking up. And central banks around the world kind of got frustrated with that process. And the Germans began to tighten. And that was really the bell that rang at the top of the markets. And investors then began to realize that the trend in liquidity was then going to go the other way, and markets crashed. And that's what we've got to look out for. But you could actually pick those signs up progressively in the fixed income markets. The fixed income markets sort of sold off gradually, and then that sell-off began to accelerate as we got nearer the bell. So we've got to look at the bond markets pretty closely. So I think there's that. And I think then if you come into what drives the bond markets, I think one of the things to start looking at very closely is not just the funding background in the US and this sort of shift towards shorter term funding, which is, I think, clearly a worrying sign, but also what's happening in international markets, and particularly Japan. and particularly Japan in the wake of this, the loss of the upper house election by the LDP. And that's something that could clearly spook the markets because Japanese bond yields they're edging ever higher.
So you're seeing the risks in the bond market that have so far been made apparent have mostly been in offshore markets, particular Japan. And even though in the US there's so much chatter about fragility of the US bond market, the 10-year yield is, has not made a new high in many years, and the 30-year yield is close to an all-time high. But really, it's all the volatility is not in the treasury market; it's in the Japanese market and foreign markets, right?
Correct. Let's go on to that. I'll put a slide up and we can look at that. But I think it's pretty instructive to look at what's happening in the bond market because it's so important. On my presentation, you'll see that slide. That's looking at the US Treasury market. The orange line is the 10-year yield. What I've done is I put some tram lines on that to try and show the trends. And what you can see is that the sort of smaller, narrower set of tram lines where the yield is currently ranging is probably an indication of the nearer term process. But what that's saying is the bond market is ranging. It's kind of ranging. It's sort of flatlining, really. It's not showing any evidence of breaking out of that smaller channel. But the thing that's worrying, which is beneath that, is the black line, which is looking at term premia. Now, term premia are rising. There's no question about that. That's the main thing that's driving the bond market. And if you look at what goes behind bonds, there are two components to think about. One of those is rate expectations, and the other is the term premia element. Now, let's look at those two in turn. If you go to the next slide, what we show there is our nowcast of the US economy, which is shown in black. So that's basically an estimate of the momentum of the US economy. It's done on a daily basis from daily releases. And it's a little bit like, well, in fact, it's the same thing as the Atlanta Fed GDP now, but it's one that we do. We do it for different economies, but this is the US equivalent. So I think you'd see a pretty similar result from their evidence and from ours. And the orange line is the number of interest rate cuts that are being discounted in the term structure. I stress this is not Fed funds futures. This is what the term structure is discounting. And it's showing the number of, on the right-hand scale, the number of rate cuts that are basically built into the system. Now, what you can see there is that around the turn of the year, there was a break between these two series. And what you normally find is that the number of rate cuts that are being discounted by the bond market pretty much match the underlying tempo of the economy. But there was a clear disconnect around the end of the year when the Fed began to get worried by stagflation. And the net result is that if you look at the black line, the momentum of the economy, you can see that over the next 12 months, what you should be getting is something like 5 cuts in Fed funds rate, 525 basis point cuts. What the market's currently discounting is somewhere between 1 and 2 cuts. So in other words, 25 to 50 basis points. And it's because of the weight of the rhetoric of the Fed, which has been less inclined to cut because of the concerns about stagflation and what the tariff thing will do, which is really the issue here. Now, this is why Trump is banging the table and saying what you should be doing is cutting rates. That's, I guess, partly for an economic argument, as that black line says, which is probably deserved, but also more particularly that if the Fed cuts rates, the cost of servicing US debt drops significantly. And that's an important point. I think my figures are right in saying that every 100 basis points off the interest rate bill is something like 250 billion saved. So these are meaningful amounts of cash to think about. Now, the next slide, which is the one that's probably the more relevant one in this debate, is term premia. But this is really a sort of drilled down version of term premia over the last 6 months. And it's looking at daily data. And what we show there are different bond markets. Now, the point to stress here, which is completely falsifies the narrative of much of the media, is that the US bond market is not losing its safe haven status. Far from it, in fact. What you see here, the term premia, or in other words, the risk premia on sovereign government debt, the dotted line at the top is the haute market in France. Now, France has a big debt problem without any question, and you can see that investors pay a premium or demand a premium to invest in oats relative to other bond markets. And this is clearly adjusting for different interest rate levels, or different policy rate levels, I should say. The black line that's just below that is the British gilt market. Now, the British gilt market has big, big problems, not unlike France. But the fact is that you've got a runaway deficit. You've got a country which is overtaxed and won't be taxed anymore. And you've got government spending, which is just shooting the light bulbs out, uncontrolled. And therefore, you've got a rising term premium on the British gilt market. The two that are really relevant here for the US, because the oat market and the gilt market are peripheral to this, are the two other major ones, which is the Japanese JGB market, which is shown as the black dotted line, and the orange solid line, which is the German Bund market. Now, if you look at those two, they're the ones that are leading the US Treasury term premium higher. In other words, US Treasury term premium and US Treasury yields are rising, not really because of what's going on in the US, but much more because of international developments. And in actual fact, the rise in US term premium this year has been about half that you've seen in other international markets. So you've got to put the US in this context. And okay, the US may be a shirt in the laundry, but it's the cleanest shirt in the laundry when you come to this analysis. And that applies. Doesn't mean to say that the dollar won't weaken against gold. Doesn't mean to say that gold is not a more secure asset, which it probably is. But the fact is that relative to other international bond markets, the US Treasury market still looks okay. Now, clearly it can go wrong from here because funding can go awry and there can be too much short-term funding. But as we stand at the moment, the pressures are coming on international yields, not from the US.
And Michael, explain two concepts to me. The dollar has been weakening. So in the currency market, it's the US asset that has been weakening. In the bond market, it is the offshore non-US foreign bond markets that have been weakening. What does that mean with the economic principle of covered interest rate parity? That basically, if the UK interest rate is lower than the US interest rate, that's pricing in basically that the UK sterling will appreciate against the dollar. So what has been happening as the dollar has been weakening, but the weakening in the bond market has been outside of the US?
Yeah, well, it's not interest rate parity is a nice theory in the textbook, but it doesn't always work. And this is another occasion of it not working. What also matters is the return on capital. And I think that the return on capital you can proxy, for example, by looking at relative economic growth rates. And if you look at how the world economy is unfolding, the US economy for the last 2 or 3 years was shooting the light bulbs out in terms of growth relative to the rest of the world. US growth has slowed now. The rest of the world has stabilized and picked up. And so the growth differential is now moving against the US, and consequently the dollar is weakening. And there's no great surprise in that. What you're seeing is, I think, generally a rebalancing of assets away from the US because the US was taking up such a large share and the US was so successful. So this is just naturally a trimming. And then you've also got the fact that if you look at relative GDP growth rates, this is what's going on. The rest of the world is picking up vis-a-vis the US. The US is clearly suffering, maybe because of concerns over tariffs or whatever it may be. There are signs that the US economy is slowing, but it's slowing down from what has been actually quite a decent pace.
And that 30-year yield in Japan, having gone from basically 0% to 3%, that is a big, big, big move. Do you think it's going to go higher? And also, I think that the yield curve control on the Japanese bond market is on the 10-year, not the 30-year. So is the Bank of Japan basically just letting the 30-year just go as high as it wants?
Yeah.
A free market?
If you take a look at the next slide, I think in the pack, you'll see there that there's the Japanese 10-year yield. And what we show there is the actual yield this is the 10-year, which is really the benchmark against which to gauge international markets. But that orange line is looking at the Japanese 10-year yield, which is currently around 1.5%. The dotted line is our estimate of fair value on the 10-year JGB. And the shaded areas are the manipulation, the yield curve control, or the quantitative and qualitative easing environment, the QQE they engaged over that period. Now, as soon as they dropped the yield curve control, our expectations of yields increased. That dotted line moved up by around 50, 60 basis points. But you can see there this convergence between the solid orange line and the dotted line, which is really the background that we've been witnessing. And that's saying you could prospectively have another 50 basis points to go in JGB yields. Now, that clearly is going to add pressure on international markets, and it's going to push yields further up. But I think to come back to this whole process, and as Lynn Alden says, nothing stops this train, but it's a slow-moving train, not an express train. These things are evolving progressively over time.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack from design to manufacturing. Historically, this unique construction methodology has helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHJack to learn more. Using a similar philosophy, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXJack to learn more. And now, back to the interview. And Michael, this debt supercycle, this explosion of government debt, really, it's been basically happening my entire life and, close to your entire life and most people watching this. It's just that from 2008 till maybe 2018, right, that decade, growth was so anemic and inflation was so low that yields were very low as well. So is it just now that because inflation is finally picking up, or above the Fed's bogey of 2%, it kind of makes sense why yields are picking up, and also just explain kind of your outlook. So you think that are you a bear on the Treasury market because foreign bond markets are selling off, and if you're a global investor and if European yields and Japanese yields are higher than U.S. yields, even though they're not, but they're rising, then it makes sense for you to allocate more to them and less to the U.S. bond market?
I think bonds are an unattractive investment in this world. We're in a world that we describe as monetary inflation. What you want in a world of monetary inflation is monetary inflation hedges. Fixed income securities are not monetary inflation hedges, they're rather the opposite. And therefore, you want to reduce those in your portfolios. And we very clearly moved from a world which you may have said was an era of monetary dominance. And that was really ushered in particular by Paul Volcker, when Volcker put the Fed really at the center of everything. And we now move to a world where you've got fiscal dominance, where the Fed is really the slave to the Treasury. And in many cases, you've got the roles of the Fed and the Treasury reversed. In a regime of fiscal dominance, it's the Fed's job really to preserve the integrity of the sovereign debt market, and it's the fiscal authorities who largely govern or determine the rate of inflation. And that's completely topsy-turvy to what you would have expected under a world of monetary dominance. In monetary dominance, it's the fiscal authorities who maintain the integrity of the government bond markets, and it's the Fed that controls inflation. We've just flipped this completely upside down. And so what the Fed is now doing is trying to maintain the integrity of the bond market. And everything that you look at in what the Fed is doing, that's how you've got to read it. I don't think the Fed is fighting inflation particularly. It's basically trying to control the stability of bonds.
And you're saying it's keeping rates high in order to keep inflation low to protect the long end of the bond market. That's what you're saying.
Yeah, I think that's a fair assessment. But if you come back to this point about what's driving US liquidity, and to come back to some of these sort of relevant points for investors, you come back to this question about what are the Fed, and maybe the Fed and the Treasury together, because I think you've got to look at them more and more as one rather than separate independent entities. What are they really trying to do? And I think that there's all this discussion about liquidity within the system coming from the authorities. Why are they trying to get rid of the SLR, the supplementary liquidity ratio, for example? That's basically to give banks more latitude to buy Treasury debt. Why do they want banks to buy Treasury debt? Because they've got a lot to sell. That's a simple reason. You look at what the Fed is doing in terms of managing bank reserves. They seem to be holding bank reserves pretty constant at about 3.3 trillion. And allied to the fact that they are obviously concerned about liquidity, given my previous statement, why would they suddenly let liquidity in the markets collapse, as some people are suggesting, following a TGA Treasury General Account rebuild? which is, I know it's slated in the data or in the projections by the Treasury, but it seems madness to do that. Why would they want to crash the markets? Because if they took 500 billion out of the markets, there would clearly be an air pocket.
And you're talking about the Treasury General Account, which goes up. It's basically the U.S. Treasury's bank account with the Federal Reserve, and it makes that money by issuing bonds or bills. And so that's been a key point of your talk about the Treasury is doing quantitative easing, which is issuing bills rather than long-term bonds. And Michael, you were a critic, although you're just not partisan, just observing what's happening, of the Biden, Yellen, last administration, Treasury issuing lots of bills. Joining you in a very stern critique was Republicans such as Scott Bessent, who are now in the Treasury themselves, and they were saying this is so irresponsible. The Yellen is just issuing bills and bills and bills. We've got to issue bonds. When I'm in, we're going to issue bonds. And for spoiler alert, it looks correct. Correct me if I'm wrong, but it looks like Bessent is continuing that policy of issuing short-term paper.
Yes, absolutely. He says he is. And what's more, President Trump has said that's what they're going to do. So I don't think they've got any choice, because otherwise they're going to wreck the markets. And the fact is that if you come back to liquidity, and what a very generic definition of liquidity of an asset is the size of that asset divided by its duration. So in other words, if you want to increase liquidity, you can either increase the amount of monetary assets in the system, or what you can do is just basically decrease raw duration. And that's what they're doing by issuing a lot of short-term debt. They're decreasing the average duration of assets held by the private sector, albeit slowly, but it's happening. And that is increasing liquidity by definition. And the other point about that, which should not be missed, is the fact is that if they're issuing so much short-dated paper, who are the buyers of that paper? And it's principally the banks. The banks love short-term paper. And if you've got a very loose fiscal policy that is driving bank deposit accounts higher, the asset that banks want on the other side of their balance sheet to essentially match the duration of a bank deposit is a short-term treasury security, whether it be a bill or a short-dated note. And that's exactly what's happening. The problem is when the banks buy government debt, it is called monetization. And what's happening in the system now, why this is a different era that we're in, and this is why I keep coming back to the point, you want monetary inflation hedges. The fact is, who is driving credit growth in the US economy? Is it the private sector? No, it is the public sector. And effectively, it's the state that is back in control. Now, that may be the world we're moving to because of aging demographics, more defense spending, etc. That's how it has to be. But the reality is that we know it always ends badly. It ends in inflation. And what you've got to do is to get monetary inflation hedges into your portfolios. That's things like gold, prime residential real estate, good quality equities, and Bitcoin.
Michael, that you're talking about the U.S. fiscal deficit, which peaked at 14% of GDP and is now only 6 or 7% of GDP. Scott Bessent, Treasury Secretary, has said he wants it to be 3% or 3.9%, 4% to lower the deficit. Do you think that the One Big Beautiful Bill, which is now part of law, which has some medical care cuts, some Medicaid cuts, but mostly is tax breaks and making tax breaks permanent. How is that going to affect the deficit?
I think it reinforces the whole point about nothing stops this train. So I think that's a great analogy. All I'm saying is that this is not an express train; it's a slow-moving train, but it's moving remorselessly. And what you've got are the jaws between outlays and receipts are getting wider and wider. And a lot of these measures that they're well-meaning measures by the administration to tariff reform, potentially cutting interest rates to get the interest rate bill down. These are great measures. They may well end up, if you look at tariff receipts, it may well turn out to be 200 billion plus this year. So these are meaningful amounts. But at the end of the day, against the size of the budget deficit, which we're counting in trillions, and those trillions are getting bigger over time, these are one-off changes that are not really going to have a meaningful impact over the longer term. They're short-term sticking plaster on the deficit. And the only way that this is controlled, not just for the US, I stress, but for every Western economy, is to cut back on welfare spending. That is easier said than done. In fact, it's very nigh impossible for a lot of countries. And what we're moving to, I think, is to draw the analogy. This is like Britain in the 1970s. And if anyone that lived through that period of socialism and welfare spending and out of control finances, where the IMF had to come in to bail out Britain in 1976, this is the world that we're moving to. It's a world where politicians have got to get to grip with this whole question about spending or welfare spending. And with demographics aging and no politician wanting to actually cut back on commitments or mandatory commitments, then you've got a problem. Every Western country has it. Japan has it. Europe has it. The US has it.
So, Michael, sounds like your view, you're bullish on risk assets in the short term and you're relatively bearish on fixed income. So, if you were a chief strategist at a big bank, you might say S&P 7,000 target end of year, and your target on the 10-year is 5% or 5.3%. I'm not going to insult you by asking you for your targets, but does that sense of, pretty bullish on stocks and pretty bearish on bonds by year end, does that roughly match with your asset allocation view? And also, what is going to be the catalyst to turn this liquidity cycle? Because when we did an interview in the first quarter of this year, you said, party on, risk assets, but, you want to stay near the door. It was a very wise decision to stay near the door for a few days and weeks of late March and early April, but the bear market was incredibly violent, but also incredibly brief. And we are just soaring like a rocket ship in every risk asset right now, as we talked about. So just how close should people be staying near the door as well? And what does your global liquidity index cycle work indicate on where this party might end and where it is time to not just stand near the door, but to actually leave?
Well, if you go back to the beginning of the presentation I sent you, and there's a chart which is called Global Liquidity Cycle, and let's begin there because that's really the foundation of what we do. That chart has got a little projection in it for basically how the cycle evolves. So this is an index of the momentum of liquidity in the world economy. By liquidity, what we mean here is the flow of money through world financial markets in the form of savings flows or new credit flows. This is not money supply. I've gone on record many times as saying that money supply is very different. Money supply is an aggregate which is about $100 trillion. So it's not, one can't dismiss it as being small. It's a significant number. It's about the size of world GDP. But global liquidity is around $70 to $80 trillion bigger. And the reason it's bigger is that it embraces all forms of liquidity. It includes shadow banking, repo market activity. And a lot of it is focused on the financial sector. And it's the financial sector that drives asset markets. Now, what this chart is showing is the cycle in global liquidity, which the sine wave, the dotted red line, is showing is about a 5 to 6 year cycle. That is a cycle of refinancing. And I'll come on to the refinancing point in a moment. But save it to say right now is that basically we're in a refinancing world where debt, the huge amounts of debt that are in the world economy, need to be rolled over. And with the average maturity of debt being 5 to 6 years, this explains the 5 to 6 year liquidity refinancing cycle. Now, that cycle last bottomed in September, October of 2022. It's been expanding ever since. This particular version is looking at the overall world. It includes China, which explains that near-term volatility, and I'll come on to China a little bit later in this presentation. But what you can see is an inflection which is occurring, and that inflection occurs around about the first quarter, our best guess, of next year. This is not a fall in liquidity, it's a slowdown, a clear inflection in that process. Now, to look at a cleaner version of that chart without China, we show the next one, which is looking at the advanced economies. And you can see that's much, much better behaved. And what it's looking at is a much smoother upward line. As I said, we'll come on to China in a moment. But that's what the liquidity cycle is basically doing. Now, let me just contrast that liquidity cycle with what's happening in the world real economy on the next slide. And what I've done on the next slide is put together World Business Confidence series weighted by GDP for all the major regions, split out region by region. And what you can see there is the Americas, Europe, and Asia. Now, where is the business cycle? It's disappeared, okay? We've still got a liquidity cycle, but we haven't got a business cycle. In fact, Asia hasn't really seen a business cycle since 2020, pretty much. There's been a business cycle, a little bit of one, but it's been hugely muted in Europe and the US, and most economies are flatlining now at a low tempo. But I think this is really explaining, or the understanding here is that what you've got is a lot of economies being driven by fiscal policy, and there's much less cycle than there was in the world economy. Now, to come back to liquidity, as I've said, and I think we touched on, the next slide is saying this cycle looks to me very much like the 1981-89 cycle, where you had the 85 Plaza Accord in the middle of that chart. The word accord is key because when politicians talk of accord, what they mean is big currency adjustments. Plaza Accord, Mar-a-Lago Accord, Louvre Accord, Shanghai Accord, all these different accords led to big currency changes. And what we may be seeing is a similar development. That expansion in the 1980s occurred because the weaker dollar allowed foreign central banks to ease, and they basically eased through until late 1987, when inflation problems basically veered up and caused the Germans to start talking seriously about tightening. And you can see the track of the orange line, which is the current cycle. We're not there yet, but we're moving in that direction, in my view. Now, the following slide is then putting all this into context and saying, what should you expect in terms of asset allocation? So that's saying this is the asset allocation cycle we use. On the right-hand side, we talk about what liquidity regime we're in: calm, speculation, turbulence, or rebound. Those are our generic climate or seasons of the liquidity cycle. And then you can see on the left-hand side which assets tend to perform at different stages of the cycle. In the upswing, it's equities, right? Around the peak, it's commodities. In the downswing, it's cash. And around the trough, it's bonds. And generally, an upswing is risk on. Generally, a downswing is risk off. And we've moved to an investment world where it's very binary. You either want to be risk on or risk off because liquidity has become so important. Now, the next slide then shows where is the world distributed in terms of those different regimes. And you can see predominantly it's the green area, risk on, which is the rebound and calm. And you've got a little bit of a pickup around the start of this year for the red or the orange later cycle bits. But now we've moved back into green again, or predominantly green. About 60% of the world is now in that green area because of more easing following the weaker dollar. Now, which assets do you own at different stages of the cycle? That's what the next chart is saying. And what it's really confirming is that previous analysis. And what it basically says is that if you're in the calm phase, the upswing of the cycle, you want equities. As the cycle starts to mature, you start to shift away from credits, more towards commodities as the cycle starts to peak, and you don't want bond duration. In terms of industry groups, you want things like cyclicals in the upswing, technology at the beginning, then moving to financials and then resources. So then if you put onto the following slide what happens to the fixed income markets, you'll see, again, that seems to be absolutely on track. So what are you seeing right now? You're basically seeing bearish steepening of the yield curve. You're seeing term premium up, but you're also seeing very, very low credit risk. And that's exactly what around this phase of the cycle. So the yield curve, the developments in the yield curve are matching as you would expect a normal cycle. What are you seeing as well? You're seeing equity outperformance. You're seeing the first signs of commodity markets moving up. Again, normal cycle. You're seeing the dollar weakening, what you normally see late in the cycle. You're seeing foreign markets beginning to outperform, what you normally see late in the cycle. And you're seeing this rotation within markets, as the next slide shows, towards different types of industry group. So we move on to things like we're moving away from cyclical growth, which is technology, more towards cyclical value. So things like more industrial names, more commodity-based names are starting to perform, and we're well away from the defensive value or defensive growth area outperforming. That comes a lot later it comes in the downswing principally. So everything we see here in terms of asset allocation, I would argue, is a very, very normal cycle. What's different is the economy. What's normal is the liquidity cycle. And that's basically how this is unfolding. Now, you can go a stage further and you can put this on a map against inflation, because what we're seeing is a monetary inflation. And the next slide is basically saying, how do you allocate strategically in a monetary inflation? Now, this data, this comes from a report we wrote actually originally 25 years ago, but it basically used data that was on the Robert Shiller database, which is freely available to everybody, and from Yale, Robert Shiller from Yale. And what this basically shows is a schematic representation of the data, which is drawing a link between inflation on the lower axis and valuation on the north-south axis. Now, fixed income as that sort of downward sloping curve in red, which says that in deflations, fixed income is fantastic. In inflations, it's terrible. Real assets, the dotted brown line, is the reverse of that. So, if you like, those are two cow horns that are sticking up. You want real assets in an inflation, and you want fixed income in a deflation. That's pretty much standard. But equities sit in the middle there. And with equity valuation, there's a sweet spot at around about 2 to 3% inflation, where you get the highest valuations. Now, if you look at that chart very closely, what it shows is that to the left of the sweet spot, the 2 to 3% inflation, equities and fixed income cross over like the blades of a pair of scissors. So they're negatively correlated through that period. And that means that in that world of low inflation, equities and bonds should be part of a portfolio. And that justifies the 60-40 mix, because bonds and equities, since they negatively correlate, form a robust portfolio that people call an all-weather portfolio. And that works very well in that regime. If you move to the right-hand side, beyond the 2 to 3% inflation threshold, you're basically in a world where equities and bonds positively correlate. Equities get derated progressively as inflation picks up, but bonds are at much, much worse valuations through that period. What you want to do is to hold more dedicated monetary inflation hedges through that regime. And that's really what we're saying. 60-40 is dead in a higher inflation world. What you need is dedicated monetary inflation hedges. The dots on the line on the equity curve show where different equity markets are. Now, I would venture that the US is ahead in the monetary inflation game, and what you're seeing is a derating of US equities as you start to get higher inflation. It's slow, but it's happening. If you look at European equities, they're around about the peak. They just think of this as a roller coaster, or maybe not. Let's not get that extreme, but let's think of it as a sequence. And what you're getting is European equities coming in the peak valuations. Japanese and Chinese equities are at much, much lower valuations. They're starting to come up as inflation picks up. So if you've got more of an inflation backdrop in Japan, there'll be a big shift out of postal savings, which are low yielding interest-bearing accounts, into equities, and that could be a sizable asset shift. China, we know, is seeing deflation, but you're starting to get the first signs that China is beginning to shift out of this deflationary process. Bond yields are now beginning to pick up a little bit in China for the first time in many months. So this process is unwinding. Now, what I might do in terms of, unless you've got a question at this stage, Jack, is to then say, what is the background for China? Because I think China is really important in this whole equation to understand. And that means we've got to go right on to later in the presentation. And I think it's called China Debt Liquidity Ratio, which is a chart that's a little bit later on. Now, what this chart is basically showing is the ratio between all debt in China and the pool of liquidity in China. And I've drawn an average line, and I show over time since 1980 how that has evolved. This is annual data, and I've projected what will happen in 2025, or what the data is showing for that. Now, economists talk about the debt GDP ratio. I've scratched my head, I never really understood that. I don't know what debt GDP really tells me, if anything. What debt liquidity tells me is something very important, because debt has to be refinanced. And if you're in a debt refinancing world, as I said, what you've got to do is to roll over your debt, and you need liquidity, in other words, balance sheet capacity in the financial sector to do that. And so what you need is a lot of liquidity. If you have a very high debt liquidity ratio, as we've seen in China, you run the risk of default risk. You run higher default risk because you can't roll over the debt, and you get financial crises. So what you tend to find is that periods when the debt liquidity ratio is low, you get asset bubbles. And when the debt liquidity ratio is high, you get financial crises. And I'll show you that as a finale in one of the last charts. This is basically saying China needs to get its debt liquidity ratio down. They can get it down if it defaults on debt, good luck with that, or it can get it down if it increases liquidity significantly. And that's what it's doing right now. So if you look at the following chart, what this is basically showing is the mechanism by which China is getting its debt ratio down. These are the daily operations of the People's Bank. It's actually a rolling 28-day index of liquidity injections into Chinese money markets by the People's Bank, the PBOC. And you can see there's been a big change since the beginning of 2025. Now, what that's showing is that China is basically turning on the money tap. And if you want that in a more or an easier chart to examine, look at the next one, which basically looks at a rolling 6-month total of that data. And you can see something is happening. The Chinese are injecting a lot of liquidity into the markets. Courtesy of the weaker dollar, they can do this. And in the last 6 months, they've injected just over 10 trillion yuan into markets, which is about just short of $1.5 trillion. Now, I think they've got to do twice that. To get the debt liquidity ratio down, they've probably got to do something like $3 trillion of net stimulus. But that's basically what they're doing. Now, the reason this is important is that it means that you're going to get a weaker Chinese yuan, because more liquidity will weaken the currency by definition. But the key question is against what? And if you look at the next chart, this shows the process as to what's been going on. And this is the point that we keep making, is that don't look at the yuan US dollar, the black line, as your marker. Look at the yuan gold price, because what China has to do to get out of its debt problem, particularly with debt in the real estate sector, is to devalue the paper yuan against real assets. Well, a great real asset is gold. And what you're seeing here is a tremendous lift in the yuan gold price. So it's China that's driving the gold markets here. They're not just printing money and increasing the demand for gold. They're also reducing the supply of gold effectively by the central bank and the finance ministry buying gold as much as they can in the world economy. And effectively, Asia is doing what Western investors are doing in the Bitcoin market, but they're doing it in gold terms. So they're moving their monetary inflation hedge in gold. We're doing it through Bitcoin and crypto. Now, one of the things that this implies as well is not just the gold price goes up, but as the next chart says, commodity markets go up. And if the Federal Reserve is really instrumental in driving financial markets, which it is, the People's Bank of China is key in driving commodity markets. And what we show here is our index of Chinese central bank liquidity in orange. The dotted line is our projection about what we think they're going to do in the next 12 months based on recent extrapolating recent data. And the black line and the dotted black line are the CRB commodity indexes with and without energy. And what you can see is there's a pretty close correlation between the Chinese liquidity cycle as determined by the People's Bank and commodity markets. And therefore, what you're likely to see is a lot of strength coming through in commodities. And I would argue that's what we're seeing now. But then if you go back to my asset allocation cycle earlier on, we're at the phase of the markets where you'd expect to see commodity markets picking up. Now, last bit to say is, how does this end? And it's not ending yet, but we're clearly late. And there's a slide I just want to finish on, which is looking at the advanced economy's debt as a percentage of liquidity. So this is showing the debt liquidity ratio for the world. Remember, we saw this just a second ago for China. This is the world. It looks very different, doesn't it? And what you've got here is a ratio which goes back again to 1980. The dotted line is the long-term equilibrium. If you look at this data statistically, it shows compelling and very strong mean reversion around that level. And what it illustrates is that when you're above the line, you basically see refinancing crises, which I've labeled. So most of those financial crises are refinancing crises. And basically, that's because there's a lot of debt relative to liquidity, and it's difficult to roll over the debt without liquidity. So you need that balance sheet capacity, and in those instances, you haven't got it. Below the line, the dotted line, what you have there is abundant liquidity. And note that we've come through this everything bubble or cryptocurrency boom or whatever you like to call it over the last decade, where there's been abundant liquidity. That's been thanks to the response to COVID, the response to the GFC. What central banks do now is they just basically create lots of liquidity in the system. On top of that, they crash interest rates to near zero, which encourages everybody to term out their debt. And the reason that we've got a problem looking forward is that a lot of debt that was termed out during the COVID crisis termed out 5 or 6 years into the future, i.e., 2026, 2027, is coming due now. And that is why that orange line picks up, because basically there's going to be an awful lot of debt to refinance. Now, this is not the end of the world yet, because what you normally find is that orange line has to go above the dotted line. But clearly, terms are getting tougher. And the following slide looks at what we call the debt liquidity cycle, and it puts this into context, because this is basically illustrating how the world economy now works. It works on collateral. This is why I emphasize that collateral is so important. This is why it's critical for the Federal Reserve and the Treasury to preserve the integrity of the US government bond market. And that's why it's critical to understand what's going on and to monitor these things. The right-hand side of that diagram is then saying this is the refinancing process. This is, if you like, a virtuous circle until it isn't, and then it becomes a vicious circle. But on the the right-hand side, it says that something like 70 to 80% of primary transactions in financial markets are now all about refinancing existing debts. No longer do you finance new capital expenditure, you're just doing rollovers of debt. And that's what financial markets have become. And that is the refinancing process. What creates the liquidity for refinancing is the left-hand side, where we show there the repo collateral wing of that chart. And what it says is that according to the Financial Stability Board, their data, that something like 78% of global lending is now collateral based. In other words, there's some backing. Think of a home mortgage backed by real estate. Think of a financial transaction backed by a US government bond, a treasury bond. That's why it's important. How do you monitor the repo collateral wing of that to see it's stable? Look at SOFR spreads, in other words, repo spreads, or the move index volatility in the bond market. And this is the sort of heads up for near-term calm, if you like. Look at the following chart. There's the move index we illustrate. The move index has basically moved back into the normal zone. Last reading was in the mid 80s. So knock a zero off that index to give you some idea about annualized bond volatility, circa 8%. It's come right down from those extremes that we've highlighted as a danger zone. So what this does is it means that the collateral multiplier and the integrity or efficacy of collateral in the system is much, much greater. So what you've got here is a benign environment, and I think the Treasury have gone out of the way to make sure that bond volatility comes down through getting down the reverse repo account and by doing Treasury buybacks. This is all instrumental in that process, and maybe the SLR demise is another factor. And then you think about the repo markets and look at the following slide, which is the repo spread. And what this shows is whether you've got collateral shortages going on. And this is basically saying, is there enough liquidity in the repo markets to provide or to facilitate good collateral? So either a shortage of good collateral or a shortage of liquidity. And that's what a spike in the repo spread is telling you. And what you can see there is, okay, we're back in the tram lines, but there's been recently quite a lot of noise. And I think the Federal Reserve in particular has managed that noise and has been deliberately managing that noise. So they've been trying to get repo spreads down within that channel. And this is looking at SOFR rates less Fed funds as my definition of that channel. I think that's been deliberately managed. I think that banks they're targeting bank reserves at about 3.3 trillion. Therefore, why would they let the TGA rebuild by 500 billion, effectively taking 500 billion out of money markets and causing a major problem in that spread? I don't think they will.
So, Michael, you say we're in the later stages of calm or transitioning into the early stages of speculation. Would you say that's where we are in the liquidity cycle?
Correct.
Okay. And you said that equities tend to do better towards in the calm, and then peak speculation, it is commodities. But is there, you haven't used this word, but if we were talking about high beta stocks, you mentioned cyclicals, I'd say highly speculative stocks in the speculative phase. do highly speculative stocks tend to do better in the speculative phase, as suggested by the term? Because now is the point, Michael, over the past few days where you're starting to see very low quality companies double in price over a week or two. And for so long in this bull market, it has been like very high quality companies that has been leading the charge. I think the baton now is being passed to at least in the US equity market, low quality speculative stocks, companies without revenue, companies without profits that define the bull market, and maybe I would say the bubble of 2021. Are you beginning to see that? And is that kind of your view that continues into a speculative phase and then we have a blow off top? And is that how bull markets mature, from good quality companies rallying to lower quality speculative companies? And is that how these things tend to end?
Certainly how they tend to end, yes, because people tend to dive into things that haven't moved, and those things that haven't moved are really the things that haven't moved for good reason, because they're probably not particularly good quality, and then people will buy anything. So I think that's a normal feature. And they're not necessarily high beta, but I think they're, as you say, they're poor quality, and that's the sort of thing you'd expect later in the cycle. So it's not unexpected, and I think it's exactly the way that you'd expect the cycle to evolve. And all I'm trying to say is that I'm just looking at data. I may be 100% wrong, who knows? But all I'm saying is that if you look at the evolution, the sequencing here, it looks like a very, very normal cycle. The yield curve is telling you that. The performance of sectors are telling you that. The weakness of the dollar is telling you that. The outperformance of international markets is telling you that. And therefore, it's not surprising that the other shoe to fall is poor quality names performing.
And what do you think could end this in 2026?
Oh, I think undoubtedly it's basically a disturbance in the funding mechanism, because we're in a world where I don't think it's a business cycle event that will affect it. It will be something like an inability of a government, maybe the US government, to fund itself. And I think the US has still got traction here, but it may be an international economy. It may be the UK has real problems in funding, and then that spooks the global bond markets. I think that's entirely possible. So I think that's one thing. But I think if you want to monitor these things closely, what I would do is to look at the evolution of the cycle to see how the clock is ticking. That will give you some idea about whether we're 9 o'clock, 10 o'clock, or midnight in terms of the markets. So if you see a big blow off in commodities, that's clearly going to be signaling the end, because that's normally a feature of an inflationary economy. And therefore, you start to get central banks reacting harshly to that. But then equally, look at more micro things, like look at the repo spread, look at things like the move index. Those are very good handles on what's happening near term.
So you think that the catalyst for an unwinding of the bull market would be something happening in the treasury market? What would that look like, and how long might that last? Because it's hard for me to imagine that happening when every asset around the entire world is bid, whether it's a low quality company, a high quality company. People are buying everything. And so if they're buying everything, how could they not buy the most risk-free asset in the world, the US Treasury market, or at least it's called the most risk-free asset in the world? And what might that look like? But a true market dysfunction event a la March 2020, or just the 10-year going to 6%, which probably we can handle that, right?
I think it's not necessarily the question of the direction; it's really the speed. If you get a sudden spike in yields, I think that's something that would clearly spook markets. And I think that if there was a sense that the Treasury or the Fed were losing control, that would be a clear heads up to a bad market. And in order to discipline the markets, the Federal Reserve would almost undoubtedly have to raise policy interest rates again. So I think that those are the sort of things to watch. It may be, as I say, it may be an international event. It may be Britain. It may be Japan. It may be yields in Japan pick up. But I think the point here that I've tried to demonstrate in the chart on term premia, that this is not just a US phenomenon. This is an international event. Basically, what you're seeing is a process by which the fiscal health of the world economy is deteriorating in front of our eyes at quite a rapid pace.
The fiscal health of world governments.
Correct. More defense spending, more welfare spending. Politicians are great at spending. They're not very good at raising revenue. And the fact is that most economies are beyond the inflection point now of the Laffer curve. And that's really the worrying dimension. I mean, if you look at Britain, I mean, don't quote me on these figures, but somebody was, I think I read or somebody told me the other day, that something like 20% of UK tax revenue comes from 1% of taxpayers. If you start to increase tax rates, they're just going to move offshore.
And I actually think that according to an interview I did last year, but who someone would know, people who help high net worth individuals have passports and the like, golden visas and so forth, that actually the UK ranks second, with China being one, of millionaires leaving the country.
I think, yeah, absolutely. China's only got more, I'm sure, more in absolute terms, but as a percentage, I'm sure the UK is peaking.
And Michael, how do you feel about Chinese equities? You pointed to the very large liquidity injections in the Chinese repo market. I couldn't help but notice the last time that happened was in the early 2024, and in 2024 we had a pretty big bull market in Chinese equities. Admittedly, one that got set off really in late September, early October. It's no secret that to longtime viewers, I've been involved in Chinese equity markets, so I clearly have a horse in this race. But what's your outlook on Chinese equities, given that the PBOC is doing large amounts of liquidity injections?
Caveat, if we can put the geopolitical risks to one side, very bullish.
Mm-hmm. And what countries are you most bullish on? China. What about the U.S.? What about Japan? And which are you underweight and why?
Well, I think if you go back to that sort of rotation diagram I tried to show, I think that US equities will still go up, but I think the gains that you're going to see internationally are going to be greater because there's already a catch up going on. So I would be looking more at Asian markets, because if China is putting its foot to the floor in terms of putting down the gas pedal, you're going to see commodity markets picking up. You're going to see shipping activity picking up. The Chinese supply chain is going to move back into action. And a lot of these Asian markets are going to move. You're already seeing that in many cases. Looking at the MSCI Emerging Market Index, you're seeing these things really start to move up strongly. So I think that would continue.
Michael, a few things that you've talked about point to one issue. So you talked about tax revenues as regards to government revenues. You talked about shipping. You talked about inflation, and really maybe inflation could kick off the bond bear market that you think could be a catalyst for a risk off episode. But all these to me point to the T word, something we haven't discussed: tariffs. I know perhaps some in our audience are tired of hearing about it. They have tariff fatigue. I totally understand it. These tariffs were announced by the Trump administration. The market puked. Then the tariffs were moderated. They were delayed until early July, and then now until early August. There's kind of two camps in terms of how people view this. One is taco, or something maybe a little less derogatory, but basically that the bark of tariffs is far worse than the bite, and that these tariffs are actually going to be pretty moderate. And then there are people who think, no, the Trump who came out on Liberation Day, April 2nd, with that board that announced very, very high tariff levels, he is the president who is going to enact these very high tariff levels. And that could have negative consequences, whether it's growth going down, spending going down, inflation going up. You mentioned shipping. Where are you on roughly that spectrum? And how is that shaping your outlook on everything we've talked about so far?
Okay, without any question, this is a negative supply side shock. And if you think about what that means, it means slower activity and it means higher prices. Without any question, there's going to be a pickup in inflation. And without any question, there's going to be some dent to growth. So I think that's for sure. And that's clearly why the Federal Reserve is sitting on its hands, because it simply doesn't know. It doesn't know. Nobody knows. Is it going to be a major tax raiser? It could be significant, but I think we're talking about somewhere in the region of my estimates, maybe 200, 300 billion, nothing really more than that. So it's important, but it's not a game changer. So from that perspective, I would say the market's probably discounted most of the potential bad news from where we are now. I would suspect it clearly could get worse if there are bigger tariffs, but I would think that the market's pretty much got a handle on this by now, or it certainly should have done.
Interesting. Even though we've gone, kind of one way, just a rocket ship up for many months now. You think it's priced in? It was priced.
But I think that it's gone up for different reasons. I think the market's gone up because there's been a lot of liquidity thrown at the system. And if you look at the rundown, go back to the point about the TGA, as I said, the other risk, which we didn't mention, or we touched on, is the TGA could be rebuilt, and that can take 500 billion out of markets. Make no mistake, that would be a catastrophe if it happened. I don't think they're going to do that, because I think the Treasury and the Fed together are too alert about the liquidity backdrop. But never say never. Now, why has the market gone up? The market's gone up for a number of reasons. One is you've basically got this backdrop, which is saying TGA down, 500 billion has gone into money markets. That's a huge boost. Okay. Number two, you've got the banks buying more Treasury debt in the open market. That is monetization. So you're getting suddenly to get monetary growth picking up in the US. And then you've got China, and then you've got Europe and the rest of the world. These have all been easing. 80% of central banks now are easing, which is why markets have gone up. Wall Street's gone up, but international markets have gone up more than Wall Street. This is the reality.
And you're not worried about a recession?
I'm worried about a recession. I don't think there's a recession on the cards yet. I think there's a slowdown on the US economy coming for the reasons I cited. But I don't think it's recessionary necessarily right now. The data is not telling us that. If you're looking at these strong gains in commodity markets, that is not consistent with a slowdown in the world economy.
Michael, I want to go back to a chart we talked about earlier, which is the US GDP momentum and the policy rate cuts being priced in. So the black line shows a deterioration of economic momentum from the fall of last year into Liberation Day, but actually it's improved somewhat, but economic momentum has weakened. But as you said, interest rate cuts being priced in have not moderated. So really we should be getting 5 interest rate cuts, but currently it's like 1.5 that is being priced. And as you say in the chart, it's the Fed stagflation fears over tariffs. And so I think that the administration, Trump, he might not put it this way, but he thinks that because inflation is so low, the Fed should cut to as low as 150 basis points. And obviously that would be pretty bullish for the stock market. And Federal Reserve independence is being questioned. President Trump has threatened to fire Powell. Then he took the threat back. Then he said to some Republican lawmakers, he put it back on the table, and then he denied that he put it on the table. It appears that President Trump wants to fire Powell, but that so far the institutions, aka Scott Bessent and other things, are preventing him to do so because that would be a serious event. But I think President Trump is unlikely to fire Powell. But what's your outlook on just the relationship between this administration and the Federal Reserve in terms of how it impacts interest rates, the Fed's view that tariffs could be inflationary, so they need to keep interest rates high, and also just how is that going to impact the bond market if Trump actually fires Powell, or if he does the shadow Fed chair and he puts in someone who's going to be super dovish, and that person is slated to go into 2026, and the bond market prices in the shadow Fed chair being super dovish, which is something that Scott Bessent talked about last year.
I think unquestionably the relationship has broken down between the administration and the Fed, and that goes without saying. Will Trump fire Powell? Who knows? Because there's a lot of unpredictable things that happen. But it would be crazy if he did, because he doesn't need to, for the simple reason he's already marked Powell's card. And he could say, if there is a recession or if there are bad events for the economy in the next 6 months or 12 months, Powell is the fall guy because he should have cut rates and Trump told him. So you might as well keep him there because he's a convenient punching bag, isn't he? So that's true. In terms of who will he appoint, I think all the people that are on the cards to replace Powell, whether it's Waller internally, whether it's Kevin Walsh, they basically want lower rates anyway, and they've said as much. They're dovish. So I think whichever way it cuts, you're going to get a more benign Fed chair. Does the Fed chair matter? I suppose theoretically one would say not. But in practice, if you look at the memoirs of different Fed chairs, it does matter because the chair tends to lead the direction of the FOMC. So I think there would be a meaningful cut in rates. How would the bond markets view that? I don't think necessarily badly, because I think the bond markets are forward-looking anyway, and a lot of that was probably already in the price. That's why generally term premium are rising. But as I say, this is not simply a US phenomenon, it's a global phenomenon. A more concern, or equal concern, I would say, is the shift in the tenor of funding away from long-dated debt towards short-dated debt, because that really comes down to the same thing. They're effectively printing money through a different mechanism. It's what I've called Treasury QE, not Fed QE. And we're not just getting the US talking about that. The Japanese are talking about it. This is a chart I think you put up which demonstrates that. And so are the Brits. This is crazy in terms of funding. And if you look at this chart, what this shows is different types of stimulus, liquidity stimulus that come from the Fed or from the US Treasury. Now, let me just explain those different elements. Traditional QE is the red area. So that's expansions in the Fed balance sheet. What I've been trying to argue for the last 2 or 3 years is there's a backdoor mechanism by which they can add liquidity. through running down the TGA or the reverse repo account or through operating losses or through the bank term funding program, these different mechanisms that I've called not QE, which is the orange bit. And then you've got a third element that I originally labeled not yield curve control, which is the black area, or you might call it Treasury QE, which is altering the tenor of the issuance calendar. So basically skewing debt issuance towards very short dated debt. And the reason that's a liquidity stimulus, as I said before, is that very crudely, liquidity is equal to an asset value divided by its duration. So if you're basically reducing the duration or average maturity of your issuance, you're effectively increasing the liquidity of the private sector. Now, what that's trying to show, and there's a projection that you can see on there on the right-hand side of the chart, is that what dominates this liquidity stimulus in the projection period is what I've called the not yield curve control, or call it Treasury QE. It's basically issuing a lot of bills. Scott Bessent said that. President Trump has said that. They're going to do that. I think we're going to take them at their word. And it's the convenient thing to do because there's huge appetite for Treasury bills. Whether it comes from the banks or from the stable coin issuers, it doesn't matter. There's big demand out there.
So far, Michael, we've given ample coverage to the central bank liquidity and the government bond markets. Let's now talk about the private markets. What have you seen in the cross-border flows, as the name of your firm, Crossborder Capital, would suggest? Because there's this big narrative out there that the dollar has been tarnished as a safe haven asset because it's too volatile. With President Trump and tariffs, they're not being treated well. So let's retreat. And also, I guess there is a formula in economics that says that the lower the trade deficit or the lower the current account deficit, I guess the lower also the capital surplus, all the money going back into the United States. So you said in the bond market, you're not seeing that at all because its term premium is widening all across the world, and in some instances more than in the U.S. bond market. But the currency market, the dollar has undoubtedly been weakened. Do you think there's any truth to that narrative that the dollar's safe haven status has been reserved, or just that it's not that people are selling dollars in droves, but it's that the marginal reserve asset is, if it used to go 60% into dollars, now it's going 58% in dollars. Is there anything there at all?
Well, I think that might be true, but I think that's just a natural rebalancing. I mean, what you've had is that US assets have outperformed so massively in the last few years that international portfolios are so full of dollars that they need to rebalance. And I think that's a natural phenomenon, but that's purely cyclical. All the evidence is, if you look at cross-border flows, that nobody is quitting the dollar. There's no big move out of the dollar in the data. That's absolutely for sure. What you're seeing, if anything, is moves into things like gold more generally. I mean, that's clearly the case. But there's no evidence that people are preferring the euro or the yen to the paper dollar. That's definitely that is. There's no evidence of that in the data at all. So I don't think the US has lost its safe haven status whatsoever. I mean, just wait for a recession to prove that, because that's what's going to bring this home. And if you get a recession internationally, people will go back into the dollar in droves. It is the safe asset.
And so, Michael, you said that you don't think a recession is in the cards in the short term. In your writing, you go even further. You say, basically, the business cycle is dead. And you say, without a normal business cycle and the traditional demand-driven inflation pressures, the trigger for a market reversal is more likely to be a debt funding crisis, as we explain below. All right. Why is the business cycle dead?
What I was trying to say there is that the business cycle demonstrably is dead because there's been no cycle, and I evidenced that earlier on. What you've had is really a flatlining over the last 2 years. There's been no real evidence of any strength. The economy's been humming along at a low tempo, but there's been no obvious peak or trough. And you can see that whether it's the ISM in the US or the Tankan in Japan or wherever it may be. There's no evidence of clear cycles. Now, I think a lot of that is probably because we've moved more and more towards a service economy, that government spending is dominating. And you can look at it another way and say, what about interest rates? If interest rates go up, is that going to slow the economy anymore? And I think that we come back to this point that in an environment where you've got fiscal dominance, where the state is very important, where the government is a big net debtor, interest rates don't play the role they once did. Now, if you're in a world of new capital raising, where you've got a very clear capital investment cycle, higher interest rates basically are the cost of capital, and that rations capital spending. But that's not happening today. if interest rates fall, you reduce the incomes of a large part of the private sector, and therefore spending slows down. So I think a lot of these things, a lot of the normal mechanisms just don't work in the way that we once thought. And this comes back to this idea that we're in a world of fiscal dominance, or monetary inflation, as I call it. Things have changed dramatically.
And what about Bitcoin and gold, which are at or around all-time highs right now? Is there good liquidity is good for liquidity sensitive assets, so stocks, gold, Bitcoin, but is there anything different about Bitcoin and gold, which don't produce anything, unlike equities, that are how they're impacted by liquidity? Is there something psychological? Is there uh, because or are is Bitcoin and basically like a triple levered Nasdaq?
Okay, let me answer that in terms of, first of all, gold. If you look at, there's a chart there at the beginning, somewhere near the beginning, called gold bullion and US real interest rates. And what that's showing is gold bullion in orange against US real interest rates, and real interest rates have been inverted. Now, the traditional economic narrative is that because if you hold gold, the opportunity cost is lost interest. So if real interest rates are high, you'd expect that the gold market would fall back. And if real interest rates are low, you'd expect the gold market to go up. Now, the black line here is real interest rates. It's TIPS yields in the US, Treasury Inflation Protected Securities. That black line is drawn inverted. So if that black line is low, it's a very high real interest rate. And what it's trying to argue is that the gold market, the orange line and the black, should correlate closely. And what in 2022 is a big divergence. Now, some have argued that that's because of the Ukraine war and the confiscation of Russian assets. I don't think that's true at all. I think it's all about the profligate fiscal policy that was really engaged, or fiscal and monetary policy that was really engaged at the end of 2022, when you started to get this sort of not yield curve control and not QE really beginning to ramp up. So that's evidence of monetary inflation. And that monetary inflation is what's driven the orange line much, much higher. And as I would argue, if you just take evidence what's happening in China, that's got a lot further to go. Another way to look at it is look at the following chart, which is a longer term chart. And this is looking at the value of federal debt in gold terms. And what it's trying to argue is that this goes right back to 1940s. And what it's saying is that if you believe that there is this chart pattern, then you've got to say that if the gold market is going up, it's going to reach a peak of something like 4,500 per ounce before that lower channel is tested by the orange line. So again, what you've got is a good relationship. And I think that if you look, for example, at the amount by which federal debt has increased since year 2000, it's gone up something like 10 times, if my memory is correct. So a tenfold increase in outstanding federal debt. And the gold market has gone up about 10, 11 times since that time. So gold has matched the expansion in the amount of debt, which is clearly a good thing. What about Bitcoin? There's an even earlier chart on Bitcoin that I'll find, which is looking at the relationship between Bitcoin and liquidity. We've done for shorter term investors, but this is basically looking at a 6-week change in both Bitcoin and in global liquidity. Global liquidity is black, Bitcoin is an orange. 6-week changes, and the global liquidity index has been shifted forward by 3 months to show that it's trying to be a predictive indicator. And it works for the most part. It's a pretty good barometer of what's going on. So it's another factor that one ought to be monitoring in terms of this equation. But generally, what is important for asset classes overall is liquidity. And if you go right back to slide 3, two earlier, you'll see the relationship between global liquidity and all world wealth. And world wealth here is defined as the total amount of equities in the world economy, total amount of fixed income securities, total amount of liquid assets, total amount of gold, precious metals, cryptocurrencies, residential real estate. And this basically is an aggregate of 450 trillion. And you can see that the returns or annual growth in that, in black, pretty much matches the global liquidity cycle. And we've projected where we think global liquidity is going to go in the next 12 months. So we think there's still growth. This is not a 2020 cycle.
But you expect liquidity to grow over the next year.
Correct.
Yeah, can you conclude your thoughts about where you think global liquidities go? Talk about how we're in the middle of an upswing and you think the upswing will continue to go up. And also, can you talk about why you think it's 2026 is going to be the end?
I didn't say we're in the middle of a cycle. I think we're in a cycle. I think we're towards the end of a cycle. Those cycles are normally, the overall cycle is 5 to 6 years. So you'd expect something like late 25, early 26 to be the sort of termination point where liquidity comes down. It may not be an absolute fall in liquidity. You don't need that. What you need is basically a significant drop in the growth rate of liquidity. That's maybe enough to shake investors. And that's what we're really looking at the risks of. Now, what would cause that to occur? And I would come back to this point about the debt maturity wall and the debt liquidity ratio as really being key factors. And that may be one of the things that absorbs liquidity, that takes it out of the market. Clearly, there can be other things. There can be a shock, such as a funding crisis, as I said, but that's unpredictable. But I think in terms of what are the systematic influences, we're in an environment in 2026, 27, where there's a lot of debt to refinance, both public and private, and that may absorb a lot of liquidity. And that comes back to your issuance point, that if you throw in corporate issuance on top of that, new corporate issuance, then you may have a bit of a problem.
So Wall Street kind of ruins the party by issuing.
I don't know about that necessarily, but I think you've got to remember that it's not just Wall Street issuing new stuff. It's also the fact you've got rollovers of existing debt, and that's really the dominant feature.
That makes sense. Michael, it's been very, very nice having you. Always appreciate your insights. People can find you on Twitter at Crossborder Cap. Your book, which is an excellent book, and that's actually how I found the title of my previous podcast, is called Capital Wars. That's also the name of your Substack. Tell us what you're doing on Substack and where people can find you there.
Substack is called Capital Wars. We write 2, 3, 4 pieces a week about what's happening in global liquidity. We provide data, allow people to monitor these measures. We write about some of these developments and asset allocation thoughts. So that's all in the Substack Capital Wars. The other source of information is our institutional service, which is crossbordercapital.com, where we basically have dedicated data feeds that we already supply a lot of quant firms with data that people are increasingly analyzing for insight into markets.
Thank you, everyone, for watching. Leave a rating and review on Apple Podcasts and Spotify, and also subscribe to the Monetary Matters YouTube channel. Thanks again.
Thank you.
Thanks for tuning in. Looking into SMH or SMHX? Head to vaneck.com/SMHjack and vaneck.com/SMHXjack to learn more. Until next time.
Thank you. Just close this door.